Breaking news: thousands of savers across the UK could be facing unexpected tax bills this year, as Revenue and Customs (HMRC) begin sending out letters to individuals who've earned more than £500 in savings interest during the 2024-2025 tax year. If you have £3,500 or more sitting in a savings account, especially in a fixed-rate one, you could be among those contacted in the coming weeks. But why is this happening, and how much could you actually owe? Let's break it all down so you're not caught off guard. Every year, HMRC conducts automatic checks using data supplied directly by banks and building societies. This allows them to track the interest generated on your savings accounts. While many savers assume that interest income is small enough to go unnoticed, the truth is that surpassing the threshold can trigger a tax bill even if you never received a warning before. The core of this situation revolves around the Personal Savings Allowance, a rule that determines how much interest you can earn tax-free. For most basic rate taxpayers, this allowance is £1,000 per year. However, once your income crosses £50,270, your allowance is halved to £500. And for high earners, those making over £125,000 annually, the allowance disappears completely. In that case, every single pound of interest becomes taxable income. This means that even modest savings can push you over the limit, especially now that interest rates have risen. For example, if you've placed £3,500 into a fixed-rate savings account at 5% interest for 3 years, you'd earn over £500 in interest, but because it's a fixed account, the interest is paid in one lump sum at the end. That means the entire £500 plus is counted in one tax year, potentially triggering a tax bill, even though you may have thought it was evenly spread out over the term. Now here's where it gets tricky. If you're a higher rate taxpayer earning between £50,271 and £125,000 annually, you only have a £500 allowance. So, earning £600 in interest would mean you owe tax on £100. That might not sound like much until you realize that as a higher rate taxpayer, you pay 40% tax on savings interest above your allowance. That's £40 gone, just like that. And if you earn over £125,000, even £500 in interest could mean a tax bill of £200. It doesn't just apply to fixed-rate accounts either. Even easy access accounts can tip you over the threshold if you've saved enough. For instance, having £11,000 in a savings account paying 5% annual interest would generate £550 a year. If your income is over £50,270, that's £50 over your allowance, and you'll owe tax on that excess. Similarly, if your total annual income is under £50,270, you're entitled to the full £1,000 savings allowance, but even that can be breached with larger deposits. A £21,000 balance at 5% interest yields £1,050, exceeding the limit and making the excess taxable. It's also important to understand that interest from a variety of sources adds up and counts toward your allowance. It's not just your main bank account that matters. If you have multiple savings accounts, fixed-rate bonds, or even certain investment accounts that pay interest, those can all contribute to your total. Unless you're saving into a cash ISA which remains tax-free regardless of the amount your bank or provider is likely reporting your interest to HMRC. With the start of the new tax year 2025-2026, HMRC has started reaching out to affected individuals. They are urging those who've exceeded their savings allowance to register for self-assessment or pay additional tax based on the interest they've received. If you receive a letter, it means your account activity has been flagged. For many, this may come as a surprise, especially if they've never had to deal with tax on savings before. You might be wondering, will I have to fill out a self-assessment tax return now? The answer is it depends. If you're employed or receive a pension, HMRC may adjust your tax code so the additional tax can be automatically collected through your wages or pension payments. Essentially, they estimate your interest for the year based on what you earned the year before, and modify your tax deductions accordingly. But if you have multiple income sources or more complex finances, you may be asked to submit a tax return to calculate the correct amount owed. The key takeaway here is that interest isn't always as invisible as people think. With rates having gone up significantly in the past 2 years, many savers have unknowingly crossed into taxable territory. And because most of us tend to set and forget our savings accounts, especially those with long fixed terms, we may not even realize when the interest payout is coming or how it impacts our taxes. What can you do about it? First, review all your savings and estimate how much interest you're set to earn this tax year. Use online calculators if necessary. Then, check your income bracket to understand how much of that interest is tax-free. If you suspect you'll go over the allowance, it may be worth shifting some of your money into a cash ISA, which remains completely tax-free. Alternatively, splitting your savings across multiple years or using accounts that pay out monthly rather than annually could help manage when the interest is crystallized and counted. Another option is to consider premium bonds, which don't pay interest but offer tax-free prize draws. While there's no guaranteed return, some people find them a more tax-efficient way to save, especially once their interest income begins to nudge past the tax-free thresholds. Also, remember that HMRC is just doing its job. They're not targeting savers unfairly, they're applying the rules set out by government policy. However, the way interest is taxed can feel confusing, particularly because it hinges on both your total earnings and the way your savings accounts are structured. That's why staying informed is crucial. This is a reminder to all savers: your interest income isn't invisible, and the threshold for getting taxed is lower than many people think. Even a few £1,000s in the right account can tip you over the line, especially with interest rates around 5%. So take a moment to check your savings, look at your recent interest statements, and assess your overall income. If you're getting close to the limit, it's better to act now than be surprised later. And if you do receive a letter from HMRC, don't panic. Read it carefully, follow the instructions, and if you're unsure, seek advice from a financial advisor or HMRC directly. Paying a little now can save you from paying a penalty later. That's all for now. Stay informed, manage your savings wisely, and always be aware of how even passive income like interest can impact your tax position. Don't forget to like, share, and subscribe to my channel for more breaking financial updates, savings tips, and tax insights to help you stay ahead. Your financial knowledge is your financial power, so hit that bell icon to never miss a crucial update. Thanks for watching, and I'll see you in the next one.